Good evening, ladies and gentlemen. The market is still showing many warning signs despite the price action continuing to press higher and higher. So in today's stock market brief show, I'm going to be talking about where I plan on looking for a buy the dip opportunity. We're going to go over the various different signals that are showing some warning signs and much more on today's stock market brief show, where we navigate the financial markets through the lens of technical and intramarket analysis. If you haven't done so already, make sure to check the pinned comment. That's where you can get access to the swing trading community with all kinds of benefits and a link to our partners, Interactive Brokers. Let's get into today's episode. All right, people, welcome back to the show. Oh, yeah. Taking a look at the 11 sectors that make up the SP 500. Technology led the way today, despite seeing some weakness out there in energies, utilities, and consumer discretionary. Overall, the markets were down on the trading session while the volatility index was up. But the big news was all about earnings. Yeah, we saw Target actually report earnings. This ended up down 8% on the day. Let me just tell you this. We've seen a lot of retail names get crushed. But the SPY held up fairly well for the majority of the day. It wasn't until later where we started getting some warning shots, and that was when the FOMC minutes came out, and they weren't all that great. They were quite hawkish. Various participants mentioned the willingness to tighten policy further should risk to outlook materialize. And then they also stated that recent data had not increased confidence in progress towards the 2% inflation target. However, does that really matter? No, of course not. NVIDIA is what matters because that's what everyone is focused on. NVIDIA reported earnings, and overall, it was everybody got what they wanted. There was a dividend increase. There was a split announcement. They confirmed the speculation that was out there, and the price action continued higher and higher up into the earnings expected move. We're kind of backed off from that point where he did reach over 1,000. If you take a look at the S&P 500, today's price action was really a nothing burger overall, but we're still sitting roughly at all-time highs. Now, some of the warning signs that are going on are things like utilities has been that outperforming sector from not only an absolute standpoint from the bottom over here. Well, technology actually led the way from the bottom, but still having utilities lead the way is somewhat of a red flag. There's been instances where this has been the case, but there's been also a lot of instances where utilities leading the way and consumer staples showing strength is not a great sign. If you look at year-to-date, right, performance, utilities is still the leading sector as it stands, up 14.66% on the year. Now, some other warning signs that are going on are some divergences that are building. Now, if we first look at the NASDAQ summation index, we're looking at this purple line. There's little pink dots on it, and the pink dots are the parabolic SAR. It's an indicator upon an indicator. And sometimes when the parabolic SAR ticks from one side of the line to the other, it can identify potential changes in trend. The last trend change we had, potential change in trend, was right here at the beginning of May. And if you just zoom right up over here, it accurately told us that the trend was going to continue to the upside. Actually, the last downside trend was right over here. And you can see the market went sideways and then it went down. Now, the current divergence that we're seeing build here is in the NASDAQ McClellan oscillator. As you can see, a high read print on the indicator and a lower high while the market's pressing into higher high territory. So as the market moves higher, the internals are telling us that it's a little bit weaker of a story. And it's not just the NASDAQ McClellan oscillator. You can look at the NYSE McClellan oscillator, and you can see here we had a high print, a lower high, and then we actually saw weakness today as that crossed back down through zero. And there's been plenty of times where we've had divergences play out to the downside, as you can see highlighted on the chart, but also positive divergences that led to upside swings as well. So we got to pay attention to both bullish and bearish divergences. On the last episode, we talked about the bearish divergences in breadth, above the 50-day over here and the 200-day moving average. And you can see that is still here as it stands. So this is telling us that as the S&P 500 is pushing higher and higher, it's doing so on less names, right? The percent of stocks above the 50-day are going down and down. So this tells us one of two things. It tells us that all the names that have been underperforming are going to start performing at some time to resolve, or the market's going to digest and pull back. Now, if we take a look at a couple other indicators like the SPXEW, which is not really an indicator, that is equal weight S&P 500. As you can see here, the S&P 500 below is making a new all-time high, while the equal weight has not done so at this moment. And there's been many instances where this can lead to pullbacks, digestions in the market. You can actually see right here where we actually went matching highs in equal weights while the S&P 500 made new highs over here, and that led to a 10% pullback in the market. If we take a look at the housing index, now the reason why housing is so important is if you go date back way to 2005, this actually topped out. This index specifically topped out in 2005 while the market kept going higher. So the larger divergences are worth noting, but there's also some smaller divergences I can pull out here too as well, dating back to early 2022, where we had equal highs over here on housing while the S&P 500 made a new high. That led to a downside move. And as the S&P 500 was recovering, housing was telling a different story, and that led to more downside. It wasn't until really the October level where housing put in a higher low and S&P 500 went down lower, and that marked actually a positive divergence in housing, and the market went up from that point. The reason why I'm calling out this now is because the S&P 500 is pressing into new high territory and housing is yet to confirm it, meaning that housing, well, may make a turnaround to go to all-time highs, or it may resolve itself as the S&P 500 pulls back. Another one interesting is Dow theory. So you can look at stuff like the transports and the Dow Jones Industrial Average, and there's been plenty of negative divergences where transports didn't match the new highs while the Dow Jones Industrial Average was matching new highs, and they resolved to the downside. On the flip to that, there was positive divergences as well that moved to the upside. The reason why I'm pointing this now is because the Dow Jones transports have been getting significantly weaker while the Dow Jones Industrials has put in new highs there too as well. We can even take a look at something like the NASDAQ 100 advanced decline line, and you can see as the NASDAQ 100 is pressing into new high territory, you can see that advanced or declined is matching highs as it stands. So is this going to resolve itself by turning back around and you're going to get more participation, or is the NASDAQ going to take a breather here once the excitement around NVIDIA fades away? The bullish percent index for the technology sector too has been cranking up higher and higher, and we're starting to get into overbought conditions in the RSI. Now, I personally like to wait for this actually to get a higher reading, and then also negative divergences to form, which we've called out in the past multiple times, and that led to pullbacks in the XLK. Pretty cool. Now, despite all those bearish things taking place, traders continue to reach out to 5,400 on the SPX. A key level to watch, though, is 5,300, because below 5,300, we ain't got much going on down here, and that could lead to some, well, increased volatility if price were to go down there. You can actually see the gamma flip line in this current moment is at 52.80. So as price pulled back into that area, dealers are still looking to buy the dip, and the market ripped up back again. Now, if we get below the gamma flip line, that's where dealers look to sell into selling, buy into buying, and you get decreased liquidity, increased volatility. Overall, though, the market's been kind of going sideways for quite some time here, and we're just trailing around that 5,300. So until this unpins from itself, we can go to 5,350 and maybe even reach to where all those traders are reaching, 5,400. In short, what does that mean? It means I'm bullish above 5,300 in the gamma flip line, but more on caution beneath those levels. If we take a look at the 15-minute time frame as it stands in this current moment, we're below the 5-day moving average. Now, NVIDIA reported earnings, so that's probably going to push us up above it. So we'll see how that resolves itself. Okay, but when we start to get a flattening and we get below it, this is a bearish, but with caution, because many times that we get below it and it's still inclining or neutral, we can snap right back up. It's not until this starts really turning around and we start to see a series of lower highs and lower lows form. Now, the weekly expected move is pretty much wide open, right? Last week closed right here, so we're basically right at this level, unchanged on the week, with an expected move going to 535.15 or down here at 523.75. And I would imagine we're going to be tagging that maybe even tomorrow, but definitely within this week. It is very likely to tag those expected moves. Now, tomorrow's daily expected move is 534.19 and then 525.47 to the downside. Now, the question that I wanted to answer before we close off today is, if we get more sell-side activity, how would I look to be buying the market? Because there's times where we might not get more sell-side activity. So let's take a look at the daily time frame. And one of the main things that I pointed out here on a different video that gave us insight to a potential move higher was when we started seeing volatility for one, but then we saw a higher low, and then we saw the higher high when it broke above this anchored volume weighted average price. And since that point, the market's basically just pressed higher and higher in positive gamma territory and above a rising 5-day moving average. So if those conditions change and we see some sell side, maybe not tomorrow, maybe not the next day, but maybe through the course of time, what you can look for is a potential pullback into the swing low anchored VWAP and or back to the swing high anchored VWAP that we broke above. Those levels are right here at about 515, and the longer we stay above these levels, they'll start to move up. So if we see weakness come in, it might not come to these levels, right? But if we see weakness, I don't buy the weakness. I look for the strength after that for potential move higher in the markets, and that's how I would look to do that. Now, what would happen if it comes down a little bit, say maybe even just to back test this prior breakout area and fill this gap, and we don't cross down further and it just turns right back around? Well, what you can do is anchor a volume weighted average price to the swing high, and if price pulls down, look for a break of that anchored VWAP to play from to the upside. That's how I would approach it. That's what I'm looking for, and that's all I got for you on today's episode, everybody. Hope it helps out, and see you later.